In this video, you'll learn how to read and analyze an income statement like a professional investor or a real business owner. This is one of the most important skills you can learn in finance. Imagine you own a coffee shop called Coffee for Analysts and you're reviewing your income statement. In simple language, the income statement shows you what the company made, what the company spent, and what's left over when all said and done. You would start by looking at the top line, also known as revenue or sales. This is the money you earned from selling coffee drinks, food, and merchandise. So if a customer buys a cup of coffee for $5, that's $5 of revenue. You want to see revenue grow over time. So in this example, we can see from 2020 to 2021, revenue grew by 20%, and then it grew by 25% the following year. If you have access to the data, you can analyze revenue further by breaking it down by product or by location to see what part of the business is growing fastest and what's growing most slowly. This can help you decide what part of the business to focus on. Maybe the new latte you launched last year was a huge hit. To increase revenue, consider adding new menu items, hosting events, or launching a new marketing campaign. Next is cost of goods sold, also known as COGS for short. These are the direct costs of what you're selling. So in this example, it would mean coffee beans, milk, cups, anything that directly goes into making that cup of coffee. It's also the cost you paid for food items that you're reselling, like cakes, pastries, and sandwiches. Generally, you want your cost of goods sold to grow more slowly than your revenues. So we can see in 2021, revenue grew faster than cost of goods sold, which is good. But in the most recent year, cost of goods sold grew faster than revenue. This could be a warning sign that the cost of your ingredients has gone up a lot in the past year. And it may mean you need to raise your prices. To improve or lower your cost of goods sold, you might consider renegotiating with your suppliers to get your coffee beans at a lower price or reducing waste. Now, if we take revenue minus cost of goods sold, we get gross profit. And gross profit shows how much money you made after the direct costs of making your products. So if you sold a cup of coffee for $5, it cost you $1 to make with the ingredients, then your gross profit on that sale would be $4. If you divide your gross profit by your revenue, you get your gross margin, which we show as a percentage. So 800 divided by 1,000 is 80% margin. And here we can see that because revenue grew faster than cost in 2021, our margin improved. But since our cost of goods sold grew faster than revenue in the most recent year, our margin went back down. Generally, we want to see our gross profit increasing over time with flat or even increasing margins over time as well. If your margins are shrinking, you might need to raise your prices to increase revenue, or find a way to reduce your costs in your cost of goods sold. You can compare your gross margin to other coffee shops in the area to see how well you stack up. What's considered a good gross margin varies a lot by industry. Coffee shops tend to have high gross margins because the ingredients are relatively cheap. Software companies also have high gross margins, while manufacturing companies tend to have very low gross margins. So make sure you're comparing your gross margin to companies that are similar to yours. The next section is your operating expenses, or opex for short. These are called indirect expenses, and they represent the money spent running the business generally that you cannot tie directly to the final items sold. So for a coffee shop, this would include your wages and benefits paid to your employees, the rent you pay for your store, any marketing campaigns as well. Any large purchases of equipment might show up as depreciation. So, for example, if you purchase a big coffee machine or a refrigerator, even if you pay for it all up front, you will depreciate that expense over time, over the lifetime of that equipment. The coffee machine is an indirect expense because it costs the same amount, no matter how many cups of coffee you sold. While the other ingredients in cost of goods sold, like coffee beans, you need more of the more cups of coffee you sell. To analyze this section, you can see if any are increasing faster than the others and if there's good reason for it. Another trick is to analyze these expenses as a percentage of revenue. So if we take our wages and benefits and divide it by our revenue, we get 40% expense margin. And we can do this for each item for each year. And this makes the trends a lot more clear. Here we can see that wages and benefits is lower as a percentage of revenue in 2022. This would not be as obvious if we just looked at the total numbers here. To improve or lower your operating expense, the business could consider cost-saving measures like using more energy-efficient equipment, being more careful with your marketing spend, or optimizing staff schedules. To analyze your core business, you want to see how your operating margin has changed over time. You also want to see how it compares to other coffee shops. In our example, gross margins are improving because wages and rent are growing more slowly than revenue. On paper, this is good, but as a business owner, we would want to make sure that we're paying enough to keep our employees happy. We wouldn't want the quality of our service to go down in the future because of low employee morale. Now, if we take gross profit and subtract total operating expenses, we get our operating income, also known as earnings before interest and taxes, or EBIT. And if you divide your operating income by your revenue, you get your operating margin. This shows the profitability of your core business. A positive operating margin means that the core business is making money. Generally, you want this number to be positive and growing. The next section is non-operating expenses. These items are not related to the core business of selling coffee. In our case, the only non-operating expense is interest expense. This implies that we've taken a loan out to fund the business that we're paying interest on. Other items that might show up here include interest income if we have cash that's earning interest, or foreign exchange impacts if we have earnings in different currencies in other countries. In our example, we know that they have a loan, so we could check the balance sheet for more details about that. We'll talk more about the balance sheet in a future video, so make sure you're subscribed. We'd want to make sure that the business will make enough money to pay the loan back. Finally, whatever income is left gets taxed. The business should work with a tax professional to ensure that they take advantage of all available deductions and credits to minimize their tax liability. Paying taxes means we made money, which is good, but we also want to pay the least amount of taxes legally possible. Subtracting tax gets us to the net income, which is also known as the bottom line of the income statement, or earnings. This is how much money the company made when all said and done. We want net income to increase each year, which we can do with higher revenues or lower cost of goods sold or operating expenses. If we divide our net income by our revenue, we get our net profit margin. We want to see our net profit margin increasing over time, and we can compare it to other similar coffee shops to see how we stack up. Once you understand each section of the income statement, the main idea is to see how each item has changed over time and how those metrics stack up to other successful companies in your industry. If you're making an investment decision, you'll also want to make sure you understand the company's future strategy. If the company is changing something about their business, then future trends for each item might look different than they did in the past.